Brad Williams, Frugal Finance. Basis risk in oil futures. It is June 8th, and the company knows that it will need to purchase 20,000 barrels of crude oil at some time in October or November. Oil future contracts are currently traded for delivery every month on NYMEX, and the contract size is 1,000 barrels. The company therefore decides to use the December contract for hedging and takes a long position in 20 December contract. The future price on June 8th is $68 per barrel. The company finds that it is ready to purchase the crude oil on November 10th. It therefore closes out its futures contract on that date. The spot price and futures price on November 10th are $70 per barrel and $69.10 per barrel. The gain on the futures contract is $69.10 minus 68 equals $1.10 per barrel. The basis when the contract is closed out is 70 minus 69.10 equals $90 per barrel. Why? Because now you have to buy the oil at the $70 spot price. The effective price paid in dollars per barrel is the final spot price less the gain on the futures, or 70 minus $1.10 equals $68.90. This can be calculated as the initial future price plus the final basis, 68 plus 0.9 equals 68.90. Total price paid is 68.90 times 20,000 equals 1.378 million versus a non-hedged amount of 70 times 20,000 equals 1.4 million. $22,000 difference. If hedged correctly, the hedge should be 70 minus 68 times 20,000 equals $40,000. Lots to think about when you're new to finance or new to futures, the difference between hedging and non-hedging and basis risk. So the total price paid is $68.90 times 20,000 equals 1.3 million versus a non-hedged amount of 70 times 20 equals 1.4 million. I know I said 1.3 million, 1.378 million. A $22,000 difference. If hedged correctly, the hedge should be 70 minus 68 times 20 equals 40 grand. You need to be cognizant of the nuances within finance. Brad Williams, Frugal Finance. Thanks for watching.